Crypto Wolf here. How you guys doing? Today I'm going to be talking about crypto trading psychology. You see, most people don't consider trading psychology as something that's important. It doesn't look important to a lot of people. As in, all they believe is just learn technical analysis, learn fundamental analysis, fund your trading account, and off you go. You start trading and you start trading hoping to make profit. That's often not how it works. And that's why a lot of people don't stay long in crypto trading. Crypto trading is different from other kinds of trading because the market is very volatile. So if you don't understand crypto trading psychology, you won't be able to do well. You won't succeed. As in, even if you master technical analysis and fundamental analysis and you start making some good profits, you're going to give it back to the market. And that's the case of a lot of experienced traders today. And that's what they keep trying to get solution for. Even if they make money from the market today, tomorrow they give it all back to the market. And there are also a lot of beginner traders that know nothing about crypto trading psychology, and they just don't know what to do. They think it's all about focusing on technical and fundamental analysis, and but that's really not the key thing. And that's why you hardly find crypto traders, as in beginner crypto traders, who stay in the market for long. Most time 3 to 6 months they are already off the market. And if you check closely, you would hardly find crypto trading psychology resources online. Why? Because people don't feel it's something that's important. They don't feel it is something that is worth it. As in, that's why you hardly see content about it on the internet. And even the content you find about it are not very detailed because people don't put much effort into trading psychology. But believe me, trading psychology is what would make or break your trading journey. It's not technical analysis, it's not fundamental analysis. Those things are good. It's good to be very good in the ability to read charts and chart patterns and all of that. But if you don't understand the psychology, you're not going to succeed. Yes, you may make some profit here and there, but you're not going to be a long term trader. Trading psychology is the very key to being able to make consistent profits from market. In this particular video, I'm going to be sharing with you the 7 epic mistakes that I made. First thing first, what is trading psychology? Trading psychology refers to the mental and emotional factors that influence decisions and behaviors of trader in the cryptocurrency market. The thing is this, as in trading is all about emotional discipline, being able to control your emotions and be able to trade based on rules. And if you're not able to do that, you won't be successful in trading. So the ability to keep your emotions in check. Trading is nothing more than emotional discipline. The ability to make rules as per how you trade and to follow it. And that's the key. So in this video, I'll talk about the 7 epic mistakes that I made so that you don't make them too. I've been a crypto trader for the past 7 years, so I've learned a lot of lessons on the way that have really helped me to become a better trader. And in this video, I will share them with you for free. The very first mistake I made as a trader was that I thought trading was all about making profits. You see, that's the first mistake every crypto trader makes. They think they are in the market to make profit. They're in the market to make money, drive Lambo, as in go to parties, as in make a lot of money to be comfortable. So a lot of people come to crypto trading with the wrong mentality, and that's why often they don't succeed. So they come with the mindset that, oh, they're going to start crypto trading within a very short time, they're going to make a lot of money and be driving Lambos and all of that. But the very first thing to do in crypto trading is not making profit, it's to protect your capital at all costs. Because if you don't protect your capital, you're not going to be in the market for long. As in, people don't realize this. You won't be a trader for long if you blow up your trading account, if you don't use stop loss. As in, if you just you just keep trading, as in thinking that your capital doesn't matter, you're careless with it, you're not going to be a trader for long, because the only thing that enables you to be in the market is because of your capital. The moment you lose that capital, you have no business anymore being in the market. You've already been kicked out. So, and that's why, as a rule for me, I don't take more than 5% loss on any trade. So if I'm trading with $500, I don't take more than $25 loss on a trade, which is 5%. And most of the times I don't go and come back and come and check, oh, is it already 5% loss, so that I can close it. I don't do that. I set it automatically. I set a stop loss that when it gets to that point, it automatically exits me from the market. Because the truth is this: small loss is better than big loss. If you lose 50% of your trading capital, you would need 100% profit to recover it, which is very difficult. Okay, take for instance, your trading capital is $1,000, for instance, and you were careless with it and you lost 50% of your capital. You will be left with $500. To recover your initial capital, you would need to make 100%, which is, it would now be $500 times 2 to get to your original initial capital. But if you lost 5% of your $1,000 capital, you will still be left with $950. And here's the trick: it is easy for you to recover a small loss compared to a big loss. And if you make a big loss, it's going to affect your mental state, and you're going to start trading irrationally. You're going to go on revenge mode. You're going to enter a trade you ought not to enter, just because you want to recover your capital by all means. So, as a rule, set a certain percentage loss you're allowed to take, maximum loss you can take in a trade. It can be 5%, it can be 10%, depending on how much you're willing to risk. But for me, as a trader, I don't take more than 5% loss. A lot of people will tell you don't take more than 2%, but the cryptocurrency market is very volatile. So 2% is really not a good margin, because any quick move in the market, you're already out. But with 5% and buying at support levels, you're rest assured that if it breaks that region, you should be out of the market. These are some of the things that I'll talk about in subsequent videos. So the first thing is protect your capital at all costs. The second is just as important as the first, and that's never add to a losing position. You see, I see a lot of crypto influencers on YouTube, and I see a lot of um, crypto traders on Binance, who keep telling you to keep adding to a losing position, and before you know it, the trade will reverse and you will be in profit. In some cases, that might never happen. You might just keep adding to a losing position, and that trade will not reverse. We've seen that in the crypto world several times, where there was a crash in a particular cryptocurrency and people kept adding to the losing position, and at the end of the day never recovered. They will tell you DCA, DCA, DCA. DCA means dollar cost averaging. It means to buy a fixed amount of a crypto at successive prices. So you could buy at, let's say, $10, then you could buy at $7, you could buy at $5. You're trying to average your risk, as in you're trying to average the price so that you reduce your risk. But I don't recommend it. Just set stop loss, and if it hits your stop loss, get out of the market. And then you then sit down and do a critical forecast, do a critical analysis, and look at the next best point to buy in again. And even if it hits your stop loss again, get out of the market. Don't keep adding to a losing position because it might never recover. These are some of the things that I learned. Believe me, I've been a trader for a long time and I've lost over three trading accounts because of these kind of mistakes. You keep adding to a losing position, keep adding to a losing position, keep adding to a losing position. And at the end of the day, if the cryptocurrency doesn't recover in time, you're left holding the bag. And sometimes you may have to wait for a long time before it would even get to your original price, before you can now sell it, and then before you can now even retrieve your capital. And oftentimes you might not have that patience because you need to make something out of your trade. Sometimes it may be the only job you have, or it may be your means of livelihood, as in you could be trading for a living. And when you're trading for a living, you need liquidity, you need funds available to take advantage of opportunities. That's why you should not tie your funds in a losing position. So that's the second mistake that I had to make. The third one is never trade your opinion. You see, one of the biggest challenge most traders make, or one of the biggest mistakes they make that I made too, was to trade my opinion, was to think I was a technical analysis superstar. And because of that, I needed to trade what I think. Don't trade what you think, trade what you see. You see, the market has its own voice. The charts have a voice. They tell you where they are going. If you listen to what they are saying, your trades, most of your trades will be profitable. But most of the times we don't want to listen. We think we know it all. We think we know what we're doing. We look at the charts, we said, nah, as in that's not what I think is going to happen. Nobody nobody cares what you think. The market doesn't care what you think. All that matters is that you trade what you see. The chart has a voice. Listen to it. Don't be acting like a technical analysis guru. Nobody cares. Because if you lose your funds, you'll be out of the market. So don't trade your opinion. Trade what you see. As in, trade what's on the chart. Keep your ego aside. Don't try to be the master guru of a trader and be trading, you see, I think Bitcoin will be going this direction. I think Bitcoin will be doing this. I think Ethereum will be doing that. I think. And that's the problem with trading. Everybody's thinking, I think this is what I think. This is my prediction. Just trade what's on the chart. The chart could tell you where it's going. So that's another mistake that I made. So this one is another mistake too that people make. Be humble after a win. You see, some traders immediately they make some money with their trades, they start to think they are invincible. They start increasing their trading sizes, increasing their position size, and doing all manner of crazy things that they ought not to do because they think they can't lose. There's nobody that can't lose. There's nobody who is invincible. Even after you've made a win, you made a good profit, let's say you got 500% in a trade, you should still be humble, because if you think you're invincible, you're going to lose everything. You're going to lose everything. There have been times where I've made some very good profits and I was thinking I was invincible. Maybe I just got successive trades, successive wins in a trade. Let's say five trades, as in five winning trades in a row. And I was like, damn, I'm invincible. As in, nothing can happen to me now. I'm at the top of the world. And just one wrong trade and all of the profit was wiped off. So be humble after a win. So another thing is to analyze the charts daily. You see, the crypto world is very dynamic. So even if you forecast a trade today, as in it could change within a matter of hours. And that's why it is important that you chart every day. As in, I know a lot of people do crypto trading for at part time and all of that, but It is important that maybe before you go to your workplace, just look at the charts and you could tell where things might be going. As in, because there are lots of things you would miss if you don't do this. There are so many trades that I've missed. There are so many insights that I've missed because I was not chatting every day. In fact, this was the missing link between me being a losing trader and becoming a profitable trader by chatting daily. In fact, there was even a trade that happened recently that I didn't see because I was not chatting daily. As in, recently, it happened recently. It just kind of reinforced the concept of daily chatting. And when I saw it play out, I was like, oh, as in, I was not looking at this. As in, if I had looked at it, I would have known. Let me just quickly show you what I'm talking about on TradingView. The recent Bitcoin crash, I would show you. I would have seen it if I was chatting daily. Let me just quickly show you what was playing here. Um, okay. Let me enable the RSI divergence indicator. So you see, just before Bitcoin crashed here down to this point, down to about 59k 672, there was a divergence that was showing here, but I didn't see it because I was not chatting daily. As in that period, I was busy with other stuff, so I wasn't seeing it. So look at this. This is also another divergence again, as in previous times. And look at what happened at the end. So you see, divergence, then a crash. This is a daily time frame. Then another divergence again, a bearish divergence, and another crash. You see, if you really want to confirm it, you could use the pitchfork as in and just draw it on it and you would see. And the pitchfork coupled with the RSI divergence are one of the most accurate ways to determine the direction of a trend. So you could see that divergence here led to a crash. Divergence here on a daily time frame led to another crash. But I didn't see that divergence because I was not chatting daily. So ensure that you chat every day, even if you're not very good at technical analysis. But if you look at it every day, you get better. That's just the secret. Another of the mistake that I made was that I didn't have a trading plan. You see, if you there's a popular saying that says if you don't plan, you're planning to fail. As in, if you fail to plan, you plan to fail. So you should have a trading plan. As in, it should highlight your risk tolerance. It should highlight the conditions before you enter a trade. As in, all of the rules should be clearly highlighted. For me, I have a trading plan that's in my trading journal. Maybe one of my other videos, I'll talk about developing a trading plan, a crypto trading plan. So it should have the conditions for you to enter a trade. I might even give my trading plan so that people could download it and make their own trading plan from it. So it should have your income target for the month, how much you're targeting. It should have your risk tolerance level, your stop loss for every trade. You should have a trading plan. A lot of people just think that, oh, they don't need it, as in they can be able to trade and be successful despite having a trading plan. You may not go far as a trader, as in that's for traders who are not serious, traders who want to use trading as a hobby, not as a business or something. They don't want to become professionals, they just want to be as in hobbyists. But for professional traders, you need a trading plan. So you should try and develop one, or you wait for one of my videos that talks about how to develop a trading plan and my own sample plan. Last but not the least, you should stick to one strategy. Believe me. As in, I've had encounters with elite traders, and literally all of them have just one strategy, and that strategy makes them a lot of money. Yes, the strategy could be refined, They could do some refinement on it, add some new parameters, you know, make some new rules to fine tune the strategy, but the core strategy is just the same. As in, they use just one strategy for their trades. Don't go about chasing different strategy. People are always all over social media, even here on YouTube, trying to look for the latest crypto trading strategy, the most efficient, the most profitable. They are going from one YouTube channel to another. You might already have a strategy. You just have to fine tune it and fine tune it and fine tune it until it becomes profitable. Don't go about running from pillar to post trying to get the latest strategy, because everyone is unique. So everyone will have a unique strategy. What works for me might not work for you. So you just have to develop your own unique strategy and stick to it. And it just has to be one strategy, it doesn't have to be two. Because the more strategies you have, the more confused you'll become. So it just has to be one strategy. And that's it. So, as in, thank you so much for watching this video. This is my very first video, so um, just expect more videos from me. As in, my goal is to really share all I know, as in, from the with the very best of intentions, so that you all become better traders. So, as in, I'll see you in my next video. Bye.